Capital FX signals, trend reversal patterns, double tops and bottoms. Double tops are a bearish reversal pattern which form after a strong move upwards. It appears as two consecutive peaks of similar heights. The first peak is a general part of the uptrend, creating a new high. After facing a resistance, price pulls back, creating a support level called the neckline. Then the price moves back to the previous resistance set by the previous peak. After falling to break it, it continues downwards to break the neckline. Let's take a look at the chart. This pattern shows the relation between bulls and bears very well. The price has been in an uptrend and creates a new high. As bulls run out of steam, the market goes into a consolidation phase and pulls back a bit. Then bulls try to drive the price to a new high, but fail once more as the bears start taking control and begin driving the price back down. Take a note that this pattern is only valid when the price breaks the neckline. Why? Because most of the time in situations like this, the price is just consolidating before the uptrend resumes and takes the price to new highs. So when do you enter the market? There are two possible entry points. One, at the close of the candlestick, which breaks the neckline. Two, at the retest of the neckline. So when do you take profit? The best thing about formation patterns is the ease of setting a price target. Measure the number of pips between the neckline and the height of the peak, and set the target by the same number of pips from the neckline downwards. Double bottoms. Double bottoms are the exact opposite. They form after a strong downtrend and indicate a bullish reversal. They consist of two bottoms of similar lows and a neckline which acts as a resistance. The same is for the pattern's bearish counterpart. The pattern is only valid when the price breaks the neckline, and we should only enter then. Summary: 1. Two peaks of similar height. 2. Clearly visible neckline. 3. Neckline is broken.